Hello there, I'm Max Keiser. This is the Keiser Report. Yes, we're still in Paris. Oh, my love for all things Stacy just grows by the minute every time I'm here in the City of Lights. Stacy?
And the city of love, it's called, right? Well, you know what? While we've been here, there has been a new fascinating term used for what you've called financial terrorists, and it used to be called financial repression. Remember, all these low rates, declining rates, negative rates, quantitative easing was considered financial repression. It was repressing all throughout the economy for the better of the whole economy. Well, here's a phrase: financial vandals. And it's an interesting one. Pension World reels from financial vandalism of falling yields. And they speak to Mark Dowding, the chief investment officer at Blue Bay Asset Management. He has pension fund mandates, and he says about these ever declining rates that, quote, the true madness is pension funds being forced to invest in assets which will be guaranteed to lose, such as in the case of long-dated inflation-linked gilts at real yields of negative 3%, he said. It is financial vandalism, and the government and central banks need to wake up to this.
Right, by the way, do I look like Picasso with this shirt? I could. That's what people stop me and say, you kind of look like Picasso with that shirt. And I say, yes, I'm going through my blue period.
In fact, his granddaughter.
His granddaughter said I look like I'm going through a blue period. But let's talk about financial vandalism for a second. So, as you point out, there was a term floated about called financial repression when interest rates were under the inflation rate. So people had a negative kind of repressed feeling about how the economy was working. And it was couched in economic language in Davos speak, and how policymakers needed to engage in this type of policy to restore integrity to the banks, or some other phrase that they would use. Then to morph now into financial vandalism means that the press, the mainstream press, well, we were accused of talking about heterodox economics when we pointed out that the phrase financial repression is just a euphemism for stealing. And people say, well, that's heterodox economics. We don't say that on CNBC or ABC or NBC or BBC.
Because it's not orthodox. It's not what all the elite and the economists who go and get their doctorate from University of Chicago, it's not what they think.
Right. Now the heterodox is becoming mainstream because of the adoption of this phrase called financial vandalism. So people are outright recognizing the fact that the policies of the interest rate setting, whether they're at zero or negative, it's about transferring wealth up. It's about moving trickle up financialization, where the bulk of the economy's earnings go to the top 0.1%. Now, I have often used the phrase financial terrorism. That will probably become in vogue in the next 6 to 12 months.
We've said that we have a global empire of debt, and that is fiat currency. It's a US dollar since 1971. We've had no gold-backed global unit of account. It's been the US dollar, and nobody knows how much they print. We can't ever really know how much they print. It does give them an exorbitant privilege. And we've talked about this being a period similar to previous periods in history where an empire begins to decline. It always happens, as Hemingway might say, slowly and then all of a sudden, right? It just, it seems to be coming all of a sudden recently that the empire is like noticeably declining. When you have the likes of Mark Carney saying this to a meeting of central bankers, Mark Carney, the head of the Bank of England, saying this to other central bankers in Jackson Hole, I was going to say Davos, but close enough, when he says that. So here, vandals, of course, you think of the Visigoths, the Goths, and the Vandals at the edge of empire, and eventually the people let them in and say, yeah, take everything, because, our emperor doesn't care about us anyway. And then, but vandalism in this case, they're starting to recognize, here these pension fund managers are recognizing that vandalism, when you think about it, is petty, willful, and destruction of property. I would posit that the empire, in this case the fiat makers, the dollar and all the central banks that are part of that system, they believe it's their property anyway. It might be in your savings. It might technically be in your pension fund right now on their balance sheet, but they could take it whenever they want. And they are taking it.
Right. I mean, there was a book that came out, 25 years ago, Barbarians at the Gate, talking about a hostile takeover of R.J. Arnabisco. And so on Wall Street, this idea of barbarianism or financial vandalism or financial or greenmail, as it was called, or activist investor or leveraged buyouts, it's accepted at a certain echelon of Wall Street. But they've run out of all the assets they can strip. So now they've come to the general population, the mom and pop out there in their pension account, their savings account. They are applying the same vandalism to your savings account.
Yes.
So they're the barbarians, the vandals on Wall Street, are now actively plundering your bank account with a negative interest rate. And it's not an economic policy. There's no economics behind it that would hew to any school of economics that has ever existed, as Dr. Michael Hudson has said, since the Bronze Age. It's just outright barbarianism.
And we've covered that for years. I mean, you look at the whole retail sector in America, you know, hundreds of year old retailers like Sears, or, you know, they totally collapse once the barbarians get a hold of the company, because what do? They strip the assets by loading it with debt. They swap all the equity for debt, all the assets for debt, all of the pension funds, the real estate. They swap all of it and they just leave a carcass there, and it it collapses like this immediately.
And that debt comes from the central bank, and the central bank is saying that the reason we keep debt low, interest rates low, is because we need to create inflation. Now we understand that in fact they've created deflation, because by allowing those cheap rates to filter into the barbarians' pockets to do the leveraged buyouts, they've destroyed all the productive real economy, all the real jobs. And all that's left are drug dealers, Jamie Dimon, and Marmite swillers.
It always happens slowly and then suddenly. And you could have people hee-hawing and jeering in comment section or on Twitter about like, it hasn't collapsed, it hasn't collapsed, it hasn't collapsed. But the thing is, just like Sears took 15, 20 years to destroy, because they keep on loading it up with more and more debt and making it a negative net worth of the company, you know, as much as they can, until it just evaporates like sand, like it just disappears overnight. And you're seeing that with these pension funds. We did warn that this is where these negative rates, where quantitative easing, because they signaled this, by the way, and it was like 2011 at Davos, where they said we need $100 trillion worth of credit. Well, somebody has to be the other side of that trade, right? And it's these pension funds, because Peter Borgdorf at Dutch fund PFZW blamed that ever lower interest rates for its coverage ratio that now stands at 94.8% at the end of July. He said, quote, "The financial situation of PFZW is starting to get dire. A pension reduction in the year 2021 has been threatening for some time, but if we have a coverage ratio at the end of this year that is lower than around 94%, we should already reduce pensions even next year."
Right, pension accounts should not have been rated. Again, getting back to the leveraged buyout artists of the 1980s and the barbarians at the gate, one of the tactics was to borrow against the pension account of a corporation, and then buy the corporation, and then sell off the pension account and raid, you know, the company in that way. Now they've applied that to across the board, global pensions everywhere being raided, and through this artificiality of ultra cheap rates to appease the barbarians. And the result is catastrophic poverty. And to people say they don't see it happening yet, I mean, when you have people defecating, open defecation in San Francisco and Los Angeles, I would posit that you've reached the end game there.
So let's talk more about this financial vandals, because where does it go? Where is it heading? And it's only going to continue to get worse until all of these pension fund monies are gone. As they say, the positive feedback loop leads to the plunge in yields, risks spawning a vicious circle for the industry. The squeeze on returns tends to widen funding gaps, forcing managers or employers to inject more cash into the plans. That's money which would have otherwise been used to fuel business or consumption. So economic growth may take a hit, boosting calls for even more monetary easing.
The real economic growth is being squeezed out. That's where you would get genuine inflation, enough to generate tax revenue to pay down debt. But instead, they're causing deflation by making money cheap enough to have the vandals and the barbarians buy all the productive assets and steal all the pension money, and to squeeze out the productive economy. That's deflation.
If you go on Twitter and look at Bloomberg or CNBC, they're saying the same thing, that it looks like quantitative easing and negative rates may actually cause deflation.
Right, and we've been saying that on this show for almost 10 years now. And we've been called, oh, you're a heterodox economist. No, we're just calling it.
I don't mind being heterodox because that's outside nobody wants to be orthodox because you become stale, you become old, you don't think clearly, and you think, well, this is the way things will always be, and that's what has been happening. That's why our economy is a disaster. But in terms of what JP Morgan says, they said the overall impact is that lower yields can induce households or companies that act as plan sponsors to save even more for their future. In our conversations with clients, the experiments of central banks with negative rates are viewed more as a policy mistake rather than a stimulus.
Yeah, well, they've always been a policy mistake, and they're going to go deeper into negative territory to double down on the mistake. Because, again, on Wall Street, they've always worked on the Martindale betting system, where you keep betting on red at the roulette wheel until you win. That's great if you have an infinite amount of cash. You will eventually win. Goldman Sachs does this all the time. That's why they always report winning trades every single day for quarter after quarter after quarter. They have no risk. But if you do it with the overall economy and say we're going to keep doubling down on betting on something like deflationary lower rates to stimulate the economy, but eventually you do, in the case of the real economy, you do run out of money. You don't have an infinite credit line.
What we're talking about here is Europe. Europe is the one with negative rates. The United States is the only investment grade economy left with positive rates. There's actually a yield. They pay people.
Well, they're the croupier.
They're the croupier. Well, they are the empire of the debt pyramid. They have the US dollar. All other currencies reference the dollar.
Right.
The euro trades against the dollar, not against any. The dollar doesn't trade against the euro. If you try to open a euro bank account in America, pas possible. You can't do it. If you want to have a bank account here in France and deposit US dollars there, they will accept it. Not in the U.S. We are the
the U.S. is the croupier.
We're the croupier.
Right, and we fund the barbarians. And they also will be more after this short break. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Roy Sabag of goldmoney.com and Minet.com. Full disclosure, we are investors in both of these fine establishments. Roy, welcome back.
Thanks for having me, Max. It's always a pleasure to be here.
Yeah, it's awesome because we talk about macroeconomics and then we talk about markets because you have a background in trading and you also have now, I guess you could say you're a startup guy with Minet is really a startup in the gold space, which is interesting. But let's talk kind of macro because I really want to get your thoughts on this and dig into the Roy Sabag brain sack here. Mark Carney, the head of the Bank of England, U.S. ally, says, and I paraphrase, the U.S. dollar is toast and the world needs to prepare an alternative. Okay, one central bank criticizing another central bank. What are your thoughts on this?
It's interesting. It's certainly a new phenomena. You wouldn't think that someone would be so blasé about criticizing the world's reserve currency.
Is he right?
He's probably partially right, but I think in his case, I had a tweet the other day which expressed my view that I just think he's one of these revolving door types that sees an opportunity to leave the Bank of England and get a big fat paycheck from one of these new crypto,
What? You're throwing it down the gauntlet right away here, the crypto thing. Where are you going to get the crypto, Roy? Just hold your horses.
Yeah, so I think this was sort of a clarion call that, his bank account is open to the highest bidder.
Right, he's like a central bank for hire, right? He came from Bank of Canada. Then he was moved over to the Bank of England. He came with George Osborne. I believe he's friends with him. I think he sees that there's a sea change, and now he's up to, as you say, it's a revolving door. And, it's interesting you dig into that because the revolving door between Wall Street and Washington is quite profound.
Well, it's shifted now. It's Washington to Silicon Valley.
Okay.
So the new Wall Street is Silicon Valley. So, Wall Street is the 90s and the early 2000s, but post-Occupy Wall Street, we now have Silicon Valley as the new...
Okay, so that's interesting. So like you had, Goldman Sachs always, their finger in every pie type of thing. once you leave Goldman, traditionally you would join up with the World Bank or the IMF, or you become an advisor to some country. And so they had this, as Matt Taibbi called it, the vampire squid. So you're detecting a little shift now, and that's more Silicon Valley. So tell us a little bit more about that.
Well, the new Goldman Sachs is, Facebook or Google or amalgam of them, and you can see it in the way that these corporations behave. You can see it in how they've tried to initially start with all these ideals like don't be evil, and one little political cycle has already destroyed that. They're no longer doing town halls at Google, and I just think that they've become far too powerful too quickly, and the American system based on a fiat currency and sort of these infallible central bankers and academics leads towards power being concentrated in the most efficient way. And I think that especially in this day with the internet and our attention spans, the power isn't in controlling capital in sort of the classical sense, but in controlling information. And so these 3 or 4 organizations today not only control information, but have become very good at manipulating information, which in turn manipulates the minds of the people. So yes, they're the new lords.
Well, an obvious example of that, I guess, would be Libra, right? So Facebook, they are trying to transition now from a social network and connecting everyone, their mantra for so long sounds so good, to getting into actual money, creating a money. And different central banks around the world have come out and voiced their objection to this, like, oh my gosh, they're competing with the central banks. And I guess that would be the most, biggest example of that, of what you're saying?
Well, I think that shows sort of how powerful they've become, that they'd have the audacity to create their own currency and do so in sort of an open way, even while they're being, investigated by the government for all these great violations. It's too early to tell where the Libra is going to go. My initial read is that it won't go anywhere and it'll just kind of fizzle out, because there are still intelligent people in the military-industrial complex and the Treasury Department, I think, that understand the importance of having a sovereign currency. Even if the people at the Federal Reserve are seeing dollar signs by revolving out of the Fed into some of these companies, I still think there are a core group of legacy individuals at the Treasury and other departments that will never allow it to happen.
In the central bank realm, for these central banks, you over there at Gold Money have been talking about this for a while. And we see central banks are buying a lot of gold. They would also seem to be agreeing with Mark Carney that there's a move away from the US dollar as world reserve currency if they're buying so much gold. What do you think?
Yeah, I agree. I mean, I was here with you last year exactly at this time, and I think that I made a few predictions, some of which panned out, some of which did not. But on the whole, I think that the greater predictions I made, the bigger ones, did pan out. And in fact, a lot of the things are panning out in a far more accelerated way. Who would have thought that 1 year later there'd be all this political upheaval in places like Hong Kong and all over Europe and even the United States? I think that, the way I try to think of the world being contrarian, when my views become mainstream, I try to sort of take another notch and become more contrarian. So I would say at this point in history, it's already settled that the U.S. is in decline. It's already settled that the U.S. will lose its dollar status. And now it's time to sort of take the Edward Gibbon, the decline and fall of Rome approach and say, well, where are we? Because are we at the Civil War stage yet? Are these shootings, is the tenor of the shootings, they're happening now by leftists and people on the right wing. Could that be perceived as a civil war at this point in the history of America? And so the way it feeds back to central banks' decisions to own gold on a global basis is, I think they're preparing. They're basically building a storehouse of wealth that basically is not tied to the Bretton Woods system anymore, to the US dollar system.
So it's more de-globalization, de-dollarization, neoliberalism is finished, and we're into a new period. And that period seems to be going to be, as many are, punctuated or announced with some kind of civil war, or pretty violent uprisings are now happening globally, and it seems to be all connected. It was only a few months ago that our friend, Barry Silbert over at his fund in New York. Grayscale, thank you. He launched that Drop Gold campaign. It seemed almost to the minute mark a bottom in the price of gold. You mentioned contrarianism. This sometimes is when you find a signal out there amongst the noise. When someone is so sure of one direction, the markets can go in the other direction. So now, since then, gold has been on a tear, and it's hitting new highs in currencies all over the world. Against the British pound, against the euro, against the yen, against the Indian rupee, almost every major currency except with the dollar, and it looks like it'll be hitting new highs against the dollar soon. So, have we hit a new bull market in gold, or is it the third leg of the bull market that started in the year 2000?
Yeah, that's kind of the academic debate. Let's put that aside for a second. We first of all, the Drop Gold campaign, I think, will go down as one of the worst calls in financial history. Here you have this, guy with all this hubris who's waging a war against an element. I knew that was a mistake to begin with. I didn't think that he would mark the bottom, as you say. But I think it's going to go down in history as just a terrible call, foolish call. And I saw it as sort of my position to respond to that. And just because I want to make sure that while the crypto world is doing what it's doing, and I'm certainly very happy that it's succeeding for all the reasons I've mentioned in the past, what I don't want to see happen is people in crypto miss out on having an allocation to precious metals. And then if for whatever reason the crypto dreams don't materialize the way that all the evangelists believe, they will have missed out on owning gold. And so if you're a diehard crypto fanatic, you should still own some gold. And what I thought was foolish about the Grayscale campaign was they were trying to use gold ownership as a funnel into Bitcoin demand. So I'm happy that I've sort of sparked the conversation. And in a way, it's almost sad that gold's gone up so rapidly, because already anyone that's listened to that advice has missed out on sort of a great diversifying position in gold.
Right. Well, here at the Keiser Report, as you know, we've been talking about gold since 2000, for 10 years. It was in the 400s, I believe. Then when the Bitcoin story became active in 2011, we were very much on that story. We've always said that both deserve place in a portfolio because they kind of fulfill similar roles. When I look at silver, and I look at that gold-silver ratio, which got to like 90 or something, which is historic divergence. And I remember back in the bull run when it made a move from 15 to 50, the conditions that favor gold, silver, and Bitcoin have only now become more pronounced. Silver, to me, seems like seems cheap.
Yeah, it's been on a tear, and I've actually gone long a lot of silver, and I see our clients getting long a tremendous amount of silver. So I agree. When precious metals begin to move, silver and platinum and even palladium move as well. And I think ultimately gold and silver will do the best in this period. I don't know how high silver will go, but I certainly agree with you that $19 feels like too low. I think could easily hit $30 or $40 on this.
Let's talk about macroeconomics for a second, because especially in silver, because people say they're buying it, gold, silver, Bitcoin, not because of inflation, but because of a fear of currency collapse, hyperinflation. What do you think about that?
I think that people buy silver for speculative purposes, but because it's an industrial metal, when speculative fervor returns to silver, there just isn't as much supply, and so it's sort of a very volatile and leveraged version of gold. And I think it often coincides when real returns or real opportunity costs for returns is diminishing. So all of a sudden you see someone like Paul Tudor Jones buying silver. He wouldn't be buying silver unless the chart told him to buy silver.
Let me jump in for a second. Warren Buffett's got 130 or 40 billion in cash.
Yeah.
It's a huge cash position.
Yeah.
And we're in a world of negative interest rates. Is Buffett going to sit there and get a negative return on his cash and still talk the talk and be anti-gold? Or is he going to swallow hard and say, I was wrong, I should be buying gold and silver and put that money to work in gold and silver and stop being such an ideological nutcase and sitting on that horrible cash?
I don't know. You'll have to ask him that. Perhaps you can arrange an interview. I can write a letter.
But in other words,
but Munger, I don't know.
If you're a shareholder,
Yeah.
you would be saying, why are you sitting on cash when you could be buying gold and silver?
Well, the shareholders of the religious cult, otherwise known by the name of Berkshire Hathaway, follow whatever the leader says. So they're not going to revolt in any way.
Would you agree that the sitting on cash is not a great place to be?
Of course not. But I'm not sure if you're aware, but Munger recently in the last 6 months came out and said, well, even gold is better than Bitcoin. In other words, he changed his view on owning gold when it's compared to something like a cryptocurrency.
Right.
So that's interesting.
That is it. We're going to pick up with that in a second. We're going to take a break. Have you for another segment. Thanks for being on this segment.
Of course.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Roy Sabag of goldmoney.com and Monet.com. You can catch us on Twitter at Keiser Report or KeiserReport.com. Until next time, bye, y'all.